Okay, I'm compelled to put this information out there on the internet for anybody that might find it useful. And I want to go over a small misconception when it comes to investing, and it's the dichotomy between growth and dividends, more specifically, how they behave over long periods of time. Because the traditional thinking is to initially invest in growth, and then once you want to retire, sell and buy dividend assets. And that's going to give you the best returns. And disclaimer, it might. Nobody can see the future, and that might indeed be the best way to go. You can see in my portfolio, I invest in both growth and dividend assets, kind of hedging my bets in case one outperforms the other in the following 10, 20 years. But in this video, I want to show the proper calculations to see how much money and income you could have in the future depending on how you invest. So let's jump straight into the calculations. This is the S&P 500 over the maximum time frame, and let's take the return over the past decade. So we got to go to 2011. Okay, so from 2011 to 2021, the S&P 500 had price appreciation of 280%. 280 divided by 10 equals roughly 28% return per year. So let's put that into an investment calculator. I'm going to assume that you have 100,000 bucks. We're talking about a 10-year time frame with the annual return of 28%. So after 10 years, you would have just over $1 million, and this is the growth path. I mean, 28% per year in growth is pretty phenomenal for 10 straight years. So definitely take all these numbers with a grain of salt. It's just to give you a rough idea. So the growth path, 100,000 bucks, 10 years, you have $1 million. And the logic here is to then sell that and put it into a dividend fund like SCHD. And SCHD has a dividend yield of 2.8%. Although historically the dividend yield is close to 3%, so I'm going to use that as the nice even number. So $1,080 times 0.03 will give you a yearly income of $32,400 if you retire by using growth and then selling it and buying dividends. So remember this number, roughly 32,000 bucks, because the income that your assets produce is what you're going to be ultimately living off of. Now let's do the same thing with a dividend ETF from the beginning. Again, this is SCHD, and this is just the price appreciation over the past roughly decade, and it has returned 205%. So we come back to this, 205 divided by 10. So this has returned roughly 20% per year in price appreciation. If you go the dividend route from the beginning with the same 100,000 bucks, 10 years, and only that 20% return, at the end of this, you would have a balance of 519,000 bucks. So on the surface, growth is better, significantly better. But the thing is, this is the wrong calculator to be using for dividend assets. A dividend calculator like this is actually the proper tool to be using. So here I input the same stats for SCHD. The total investment is the same 100,000 bucks. The share price for SCHD right now is roughly 77 bucks. So that means you have 1,298 shares. The same 10-year holding period. The dividend yield right now is roughly that 3%. For both these calculators, just to keep it simple, we're not doing any additional annual contributions. This even takes into consideration the dividend tax rate. The expected annual dividend increase, this is where all the power comes from. I put in a conservative 10%. If we come back to the data on SCHD and go to their dividend growth page, here is the annual year-over-year growth in the dividend. So some years it's like 7%, more recently it's been close to 20, so I decided to put in that 10% per year in growth. If you want, you can mess around with the numbers and see the results it gives you. The annual share price appreciation was 20% based off of this calculation that we took. And another thing that's specific to dividends is DRIP, which stands for Dividend Reinvestment Plan. So over the 10 years, it's taken your dividend payments, which grow 10% per year, and it's compounding back in on itself. So taking a look at the results, this is it year by year. Ultimately, we're going to end with a balance of 869,000 bucks, which in absolute terms is less than the 1 million with the growth path. However, with the growth path, once you take this million and put it in SCHD, you would have income of roughly 32,000 bucks per year. But the magic with dividend investing from day one is that over the 10 years, the dividend is growing and compounding by 10% per year. So even though you have a smaller balance, you have yearly income of 50,000 bucks, which is significantly more than with the other option. And that's mostly thanks to both the DRIP, so the dividend being reinvested to buy additional shares, and the shares that you bought on day one increasing their dividends by 10% every single year. And just to illustrate this point, because I know it can be a little bit confusing, again, this is the data for SCHD. And going back over the past decade, we can see the annual payout amounts right here. So in 2013, it was 90 cents per share. And in 2020, it's $2 per share, and that's because of the growth. However, the starting yield is roughly unchanged, and that's because the share price is increasing during this time. Just to hammer this home, this is the math behind how the dividend yield is calculated. So it's the annual dividends per share, which is set by the company. The company and the management can decide to raise it by 10 cents per share, and that's divided by the current share price. So in a hypothetical situation, even if a company is raising their dividend by 10% per year, if their share price is increasing by 20% per year, the dividend yield is actually going to be decreasing over time. That's why if you can buy a dividend asset and hold it for the long term, you benefit from this, the CAGR. And with SCHD, it is quite significant. To wrap up this point, after you buy a dividend asset, the current share price becomes fixed. It's your cost basis. And the only thing that changes is the annual dividends per share, which with dividend growth assets grows over time. And that's the power of dividend growth investing over long periods of time. So I just wanted to put this information out there because it's almost set in stone that you're supposed to invest in growth now and then dividends later. And that might very well be the best way to go. Nobody can see the future. I don't know what's going to happen. And that's why I hedge my bets and I invest in both growth and dividend assets. But as I just showed, investing in dividends from day one and giving it the time it needs to compound and have significant returns is also a very viable option. Let us know in the comments below your thoughts on this whole thing. If you're still watching and enjoyed, give the video a like, subscribe to the channel. Also, we have a Patreon, so if you want to support what I do, link down below. But regardless, I'll see you guys in the next one.